Investing in a business without knowing its financial health is like trying to flirt with someone you cannot see in the dark. Luck might work out, but relying on luck alone is not a reliable way to consistently achieve better than average financial results. If you don't know how to read and interpret an income statement, by the end of this video, you will have a basic knowledge of what to look for and what it means. So let's dive in! Finance is a language that describes a business, and financial reports are the stories it tells. When you invest in specific companies, it's key to grasp and make sense of the numbers in their financial statements. Those numbers tell you the story of the company and the industry it's in. Some investors miss out on success because they either don't pay attention to the story behind those numbers or don't have the skills to understand what those numbers mean. So the question is how to read and interpret an income statement. The income statement, sometimes called the profit and loss statement or P&L, is one of the three key financial reports alongside with the cash flow statement and the balance sheet. For most people, there is a big focus on profitability. Profit is one thing very important, and it's one of three must-haves for a company to be considered financially successful. The other two being cash flow and return on investment. The income statement measures the profitability of a business during a specific time, like a month, a quarter, or a year. The cash flow statement tracks how cash moves in and out of a company during a specific period. The balance sheet helps you figure out your return on investment. When a business is successful, it's when all three areas come together and overlap. It's a business that consistently generates a lot of profits for the investment required, and the cash generated by those profits is not required for the company to stay in business. This means that the company can either give the cash it makes to its shareholders or use it for growth without having to consistently spend it in big upgrades, like retooling its factory, as you often see in the car industry when they introduce new models. Put simply, an income statement shows how much money a company makes by selling its products and services. It then subtracts the money spent on costs and expenses required to make and deliver those sales. What remains is either a loss or a profit. When you are looking at the income statement of a lemonade stand or Amazon, the basic idea is the same. Did they make any money this month, quarter, or year? Before we dive into understanding what the numbers of a typical income statement mean, let's first define the components of a typical income statement. This is what an usual income statement looks like. Revenues is the amount of money customers pay a company for its products or services. If you have a lemonade stand, it's all the money you make from selling your delicious drinks. It might also be referred to as sales, turnover, or top line. Revenues is typically the benchmark against which we compare all the other parts of the income statement. Cost of goods sold, or COGS, is what a company spends to make each unit of the product it sells. If you're selling lemonade, COGS would include the cost for lemons, cups, sugar, and the labor directly involved in making the lemonade. In a service business, cost of goods sold is the labor cost of the people providing the service. For a house cleaning service, this means the hours worked by the cleaning staff when they are cleaning someone's house. It might also be referred to as cost of sales, cost of revenue, or cost of service. Cost of goods sold doesn't cover the labor expenses for sales, marketing, research and development, human resources, or finance teams. It only includes the direct cost related to making or delivering the product or service being sold. Gross profit is the difference between your revenues and your cost of goods sold, and it's a key figure we'll discuss shortly. Selling, general and administrative expenses, or SG&A expenses, are everything else, like labor and expenses, relating to support functions. It's in this category you will find expenses related to employees, commissions, and advertising dollars for sales and marketing. If you're running a lemonade stand, this would usually include the money you spend on marketing and advertising to promote it, like flyers, posters, and social media ads. Expenses that cover things like finance, legal, compliance, customer services, human resources, and the salaries of top executives will also fall into this category. It also covers the cost of liability insurance in case there are accidents or injuries at the stand, any fees you need to pay to the city for permits and licenses to run your stand, and any rent if you are in a prime location. Research and development, or R&D, is the expense associated with inventing or developing new products. For a company like Apple, it covers the salaries of the engineers who design their upcoming products to introduce new innovations to the market. Because those engineers are not working on the factory floor, their expenses don't belong in the cost of goods sold category. Depreciation is a way to spread out the cost of an asset like a car, a machine, or a building over a number of years, even though you paid for it all at once. This is done to demonstrate how much that item has worn out or decreased in value as you use it in your business. If you run a lemonade stand and buy a lemon squeezer for $1,000 that should work for 10 years, your income statement will show a depreciation cost of $100 per year for 10 years if you decide to spread out the cost evenly over time. This helps to figure out how much profit a business actually earns when we consider the expense of using its equipment. Your operating expenses are the total of your research and development, selling, general and administrative expenses, and depreciation expenses combined. Operating income is what's left after you subtract your operating expenses from your gross profit. It's a key measure of how profitable the company is because it shows the profit or loss from the core business activities. Now, let's look at a simple example of an income statement to start analyzing it. Is a 10,000 gross profit good? Is a 10 million gross profit good? Is a 1 billion gross profit good? Should you invest in a company for this achievement? It's actually unclear if the company has performed really well or not. You cannot really tell if a number on an income statement is good or bad unless you compare it to something else. This view is also held by Warren Buffett, the world's greatest investor.
Well, what I'm trying to do as I read reports, I like to understand just generally what's going on in all kinds of businesses. If we own stock in a company, in an industry, and there are 8 other companies that are in the same industry, I want to own or be on the mailing list for the reports for the other 8 because I can't understand how my company is doing unless I understand what the other 8 are doing. I want to have the perspective of, in terms of market share or what's going on in the business or their margins or the trend of margins or all kinds of things that I can't get unless I know. I can't be an intelligent owner of a business unless I know what all the other businesses in that industry are doing. And so I try to get that information out of a report.
When you analyze an income statement metric, there are 3 types of comparisons to consider. Comparison number 1, compare the figure to a previous time period. Comparison number 2, convert the figure into a percentage of revenues. Comparison number 3, compare the figure to similar companies in the industry. One way to assess the financials is by comparing a number from the current time period to the same number from a previous period. If you are running a lemonade stand that made $5,000 last month and $10,000 this month, your sales increased by 100%. This gives you helpful information and shows you a trend. Are revenues increasing or decreasing? Is operating income increasing or decreasing? Keeping an eye on key metrics to track the trend is key when you are monitoring financial numbers. At first look, you might think, whoa, a 100% increase in revenue from one month to the next is amazing. In many cases, doubling sales can be a positive thing. However, is it always true? It's possible for your sales to jump from $5,000 to $10,000 in one period, but your company could still go out of business shortly afterward. If your lemonade stand is not making a profit, meaning that for every cup you sell you lose money, maybe sales doubled, but your company's losses grew significantly. In this specific situation, sales increased, but profits decreased. Although comparing a financial metric from one time to another is helpful, it doesn't give the full story. You need to compare a metric in the income statement to some items on the same statement for the same time period. Whenever you get an income statement listed in dollars, euros, pounds, or any other currency, it's important to convert every number into a percentage of sales. When you express an income statement as a percentage of revenues, you can easily compare 2 businesses, even if they are different sizes. If you compare your lemonade stand to a competitor and you have an operating income of 50% while they have 30%, that tells you something important. You are keeping 50 cents in profit from your operations for every dollar of revenue you make, while your competitor is only keeping 30 cents. When you express operating income as a percentage of sales, it's called operating margin. When you express gross profit as a percentage of revenues, it's called gross margin. Once you have converted items into percentage of revenues, you can compare them among different companies. Every industry has standards that you can use to compare your company's financial performance. Comparing gross profits as a percentage of revenues between two companies can show you how efficiently a company produces its products and whether it can charge higher prices for them. Let's compare the gross margins of Apple and Dell. The first two columns display the first few lines of Dell's and Apple's income statements. The last two columns represent Apple's business's two segments, selling physical products and selling digital services. The first thing I'd like you to notice is the difference in the gross profit percentage between Dell and Apple. Dell has a gross profit margin of 20%, while Apple's is a remarkable 45%. Other than saying that Apple's number is more than twice as big as Dell's, what does this actually mean? When Dell sells something for $100, it costs them $80 to make it. Dell makes $20 as gross profit from that sale, and they need to use that money to cover all non-manufacturing employees and expenses. When Apple sells something for $100, it only costs them $55 to make it. So Apple has $45 as gross profit, and they can use that money to cover non-manufacturing employees and expenses. Remember, gross profit equals revenues minus cost of goods sold. Simply put, this shows that Apple can either sell products at higher prices compared to Dell and/or make products more cost-effectively than Dell. The first increases revenues generated per product, while the latter reduces cost of goods sold. Apple usually makes between 300 and 400 billion in revenue annually, while Dell's revenue is around 35 billion per year. Because Apple generates almost 10 times more revenues than Dell, they probably have significant bargaining power when negotiating prices with their suppliers. Additionally, Apple is known for selling its product at high prices, and its flagship iPhone is far from being the cheapest in the market. Now, if you look at Apple's two segments, products and services, there's even more to the story. Apple's product business makes a gross profit of 37.5% as a percentage of its revenue. Apple's digital service business, which include iTunes, iBooks, Apple TV digital content, and iCloud data storage, achieves a gross profit of 75% as a percentage of its sales. You can notice that Apple's service business boosts the overall profitability of the company. The gross margins tell a story. In this case, it shows that Apple can charge higher prices and probably enjoys manufacturing cost benefits. However, the numbers alone don't always answer an important question. Why Apple can charge premium prices and have manufacturing cost advantages? Higher gross margins indicate that a company likely has a competitive advantage, which enables them to either charge higher prices or secure lower costs from suppliers. Competitive advantage can come from a company's ability to charge higher prices because of its brand, the difficulty for its customers to switch to another provider, the network effects that customers benefit from, the absence of alternative for customers, or a unique secret the company possesses. A competitive advantage can also come from a company's ability to be the low-cost producer and provide the lowest prices to its customers. When a company maintains superior gross margins for years or decades, it doesn't just show that they have a competitive advantage. It shows that they have a durable competitive advantage. When you look at a company's gross profit margin over time and see it dropping from one year to the next, it's usually not a positive sign. A declining gross profit margin for a single company shows that the company's competitive advantage is weakening. When most companies in an industry experience a decreasing gross profit margin, it tells a different story. If most companies in an industry are seeing their gross profit margins decrease, it can show two things. Either customers consider the products or services in the industry as a commodity, where one is just as good as the other, with no clear advantage, or a price war has broken out among competitors because they cannot compete in any other way except by reducing prices. When most companies in an industry see their gross profit margins decrease, it means that the industry has become a commodity business. A commodity industry is one where the products or services offered are very similar across different companies, and customers often choose based on price or convenience rather than unique features. Commodity businesses usually have very slim profit margins. In those situations, businesses often keep reducing prices, which leads to lower gross profit margin until one or more competitors go out of business. In a commodity industry, the advantage goes to the largest players who have more bargaining powers with suppliers and can secure lower prices to produce their products or deliver their services. Being a small player in a commodity industry is brutal. Another important area to look at is a company's expenses relating to selling, general, and administrative activities, commonly called SG&A. It's key to compare those expenses among companies in the same industry because some industries will require higher SG&A expenses for specific reasons. For example, pharmaceutical companies spend heavily on compliance and regulatory activities to make sure that they can sell their products in line with regulatory requirements. When you compare a company's SG&A expenses to its competitors, it's also key to express those expenses as a percentage of revenues. This helps you see if a company is spending more or less than its peers in relation to its revenues. Looking at those expenses as a percentage of sales give you different insights. If your company has a higher SG&A as a percentage of sales than its competitors, it can be because of those key factors. It could be because the company has a lot of sales and marketing expenses, which shows that they might have an expensive way of attracting new customers or struggle to get repeat business from first-time customers. It might also be because of high general and administrative expenses, showing that the company spends a lot in support staff or is taking an aggressive approach to growing its revenue by rapidly hiring more employees. Let's look at those key drivers one by one. In well-managed businesses, customers often make repeat purchases without the company having to spend a lot on sales and marketing to secure each sale. If a company's SG&A expenses are higher than its competitors because of its sales and marketing expenses, it's worth questioning whether customers are satisfied with the company's products and services. When people like your product or service, they become your marketing department. Costco is a US retailer famous for offering a variety of products at affordable prices. If you are a Costco fan, you probably make some trips at their stores to save on some items. You also probably first learn about them through recommendations from others or from hearing about them in the news over the years. Thanks to this, Costco doesn't spend much on sales and marketing to gain you as a long-term customer. And guess what? Every dollar that they don't spend on sales and marketing to find new customers is a dollar that they get to keep for themselves. On the flip side, companies that have poor products and services have dissatisfied customers. They struggle to retain buyers and end up with high sales and marketing expenses. When a company experiences strong revenue growth while keeping its sales and marketing expenses low, that should get your attention, and you should be asking yourself, how are they achieving outstanding sales without significant spending on sales and marketing? The answer usually lies in the fact that their product or service is so outstanding that customers keep coming back for more and recommend it to others. When a company has high general and administrative expenses because of its support functions, like finance, human resources, legal, and customer services, it often shows that the company is not managing these non-revenue generating roles efficiently. This could be because their processes are not well established, they haven't invested enough in technology, they have hired too many people, they are not managing performance effectively, or they have bad products and services. It can sometimes be a conscious decision aligned with the company's strategy if it's going for an aggressive revenue growth posture. When a company wants to expand fast, they will intentionally hire many employees in a short period of time. In fast-growing companies, it's key because it takes a lot of time to find and train new employees. New employees are not very productive during their initial months. Even the best employees need time to become skilled at their job. The faster a company is growing, the earlier it needs to make new hires. A word of caution is needed for companies that cut their SG&A expenses too aggressively and end up with much lower expenses than their competitors. For a pharmaceutical company, this significant expense reduction might have come from cutting down on compliance expenses. The risk of being fined by the regulator for not following the rules can be much more expensive than the money saved from cutting costs on compliance. If a company reduces its research and development expenses, especially when they used to spend as much as other competitors in the industry, it might be a red flag. Reducing R&D expenses can show that the company has stopped investing in future products. Sometimes you will see this when a company is very short-term focused and they are aiming to be acquired by another company. Most R&D efforts involve spending money today for creating products that will be sold a few years later. If a company wants to look more profitable in the short term because they aim to be sold to another company, they can cut a lot of jobs in their R&D department to make their earnings look better. This practice is usually not really liked because it means that the company won't have new products to sell in the future, which can hurt its long-term growth. Depreciation is an expense that some companies don't always show when they report their earnings from their operations. They often prefer to focus on a number called EBITDA, which stands for earnings before interest, tax, depreciation, and amortization. And you won't find this number on the income statement. When you analyze the company as an investor and they exclude depreciation expenses from their earnings, it raises some concerns. Let's look at what Warren Buffett and the late Charlie Munger think about it.
I think the EBITDA has been a term that has cost a lot of investors a lot of money. You saw it in the telecom field. I mean, the idea that they were spending money so damn fast, I mean, they couldn't have it coming in the door fast enough from investors. And then they pretended that depreciation was not a real expense. That's nonsense. I mean, it couldn't be worse. And a generation of investors were sort of brought up to believe in that. We at Berkshire will spend more than our depreciation this year. We spent more than our depreciation last year. We spent more than our depreciation the year before that. Depreciation is a real expense. It's just as much as the expenditure for lights. It's not a non-cash expense. It's a cash expense. You just spend it first. I mean, the cash is gone. And it's a delayed recording of cash expense. How anybody can turn that into something they use as a metric that talks about earnings is beyond me. Charlie?
Yeah, I think you would understand any presentation using the word EBITDA if every time you saw that word, you just substituted the phrase bullshit earnings.
As you can see, they believe that depreciation is a genuine expense and should be never left out when calculating earnings. Excluding it might give a false impression of higher short-term earnings that don't reflect the true financial health of the business. The total of the company's SG&A expenses, research and development expenses, and depreciation expenses add up to its operating expenses. If you deduct those operating expenses from the gross profit, you get a number that shows the operating income, but only if it's a positive value. If it's a negative value, it means that the company has an operating loss, which indicates that they are losing money from their operations. Reducing operating expenses is key to increasing operating income, just like cutting on any cost helps you boost your profits. But operating income is not the final profit a company makes, because there are a few more items to consider. Interest expense on an income statement represents the money a company pays for the interest on its debt during a specific time. A very high interest expense shows that the company owes a lot of money, and every dollar that they use to pay off that debt is a dollar that they cannot keep as profit. Just like any other individual, if you have to pay off a debt, it's less money that you can save. When a company sells an asset other than inventory, the profit or loss from that sale is recorded under gain or loss on sale of assets. An asset is something of value that a company owns, like an equipment or a property. If a company sells a building and earns a profit of $300,000, that profit will be recorded under this category. Sometimes those one-time events can significantly boost its earnings. Because those are one-time events, the cautious approach is to exclude them when calculating the company's net earning to show if it has a long-term competitive advantage or not. It's a way to make sure that unusual events don't cloud your judgment about the company's normal operations. Income before tax is what a company earns after covering all expenses but before paying income tax. Similar to individual taxpayers, companies in most countries have to pay taxes on their income. When a company pays taxes, they record that expense under a category called income tax paid. After subtracting all the costs, expenses, and taxes from a company's revenue, we get the company's net earnings. This is the profit or loss the company made. A single year's net earnings entry doesn't provide much meaningful information. What is more important is the consistency and the long-term growth trend of earnings, which indicates if a company has a durable competitive advantage. Be cautious when using earnings per share to assess a company's earning trend instead of looking at the overall net earnings number. The earnings per share, or EPS, is the number that is often reported in the news when a company's financial results are published. This is a number that most financial analysts pay attention to. It is the company's earnings divided by the number of shares outstanding. The number of shares outstanding is how many shares of a company are available for anyone to buy on the market. Companies can buy their own shares through a program called share repurchase or buyback. This reduces the number of shares available for the public to buy in the market. When a company buys back some of its shares, it means that there are fewer shares left in the open market. So when they calculate the EPS, there are fewer shares to divide the earnings by, making the earnings per share appear higher, even if the company's total earnings haven't gone up. Let's go through a quick example to get this better. If a company makes $10 as net earnings in 2023 and has 10 shares available in the public market, its EPS is $1. If 12 months later, in 2024, the company still makes $10 in net earnings but has bought back 5 of its shares during that year, those $10 in earnings will now be divided by the remaining 5 outstanding shares, resulting in an EPS of $2. Even though the EPS doubled by going from $1 in 2023 to $2 in 2024, the company's overall net earnings didn't change as it stayed at $10 for both years. In some cases, when a company buys back a lot of its own shares, it can make its EPS goes up, even though their profits actually go down. A company with a durable competitive advantage will also show a higher net profit margin compared to its competitors. If you have to pick between investing in a company making $2 billion in net earnings from $10 billion in total revenue, or a company making $5 billion in net earnings from $100 billion in total revenue, the one making $2 billion is a better investment. The company making $2 billion is a better investment because it's earning 20% on total revenues, while the one making $5 billion is only earning 5% on total revenues. Total revenue by itself doesn't tell much about a business, but when you compare it to net earnings, it shows how the business has performed compared to its competitors. If a company consistently makes a net profit margin of 20% over time, it's likely because they have a strong, durable competitive advantage. The income statement is mainly quantitatively oriented. Keep in mind that analyzing numbers is just one part of the picture. A quantitative analysis is necessary, but not sufficient. It tells you what is happening, but it doesn't necessarily tell you why and how it's happening. To find out responses to the questions how and why, you must add a qualitative analysis to your quantitative analysis. This is the other part of the picture. When flirting, people often say that physical attractiveness gets attention, but a person's inner qualities keep that attention. If you invest in a company based only on numbers and ignore the qualitative aspects, you might be drawn to a great company, but if it faces temporary difficulties, you won't have the insights to weather the storm and stay invested. This is it for today, guys. If you got some value from this video, feel free to hit like. And if you want to receive more contents like this, feel free to subscribe. Thank you all and peace out.